Hello and welcome to Market Domination. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
If you go back and you look at the 2017 bull market or the 2021 bull market, historically we see anywhere between 4 to 7 drawdowns of 30% or more. And so really what we're seeing is just what has always happened. Bitcoin is a volatile asset. That's what people are buying. It's buying volatility. So if you want Bitcoin to go up, you've got to be okay with it going down sometimes. And these kind of cooling off periods or these consolidations are very natural.
Keep in mind, the damage has been done. The damage of these tariffs has already been done. They've seeded tremendous uncertainty. They've created a sense that the United States is no longer a trusted trade partner. And if I'm the UK Prime Minister flying back home, my first thought is it even worth the candle? What is a US trade deal if the obligations can so readily be thrown out the window?
We're generally very excited about everything that's coming up. In particular, we have historically we've had the free version of Duolingo and also the premium version called Super Duolingo. Over the last, call it, year and a half, we've started adding a new higher tier called Duolingo Max, which is getting really good adoption. It's about twice the price of Super Duolingo. And what it has is it has really good AI features that help people practice conversation. And we're seeing really good adoption on that.
We got 1 hour to go until the market close, and we have been seeing stocks bounce around quite a bit over the course of the session. We had PCE this morning. They came in largely in line with estimates, not showing anything alarming on the inflation front. So let's look at the action here. The Dow briefly dipping into the red a couple times here, sort of mid-afternoon. Now it's up by about 0.5%, a little more than 200 points. The S&P 500 also up 0.5%, and the Nasdaq about 0.5%. So we're confronted with, at least for now, a different feeling than we've been seeing, a different movement than we've been seeing recently, heading into a weekend, this line going up instead of going down. But there's still time.
Yeah, PCE was interesting. Of course, the Fed's preferred inflation gauge, because it did come in largely as expected, Julie. And it was interesting to read some of the economists' reaction, response to that. Some of them telling their clients, off that data point, off that print, you could see where the Fed could say, hey, further progress has been made. Maybe they say you could even envision a cut by mid-year. But the issue, of course, is you have a lot of other balls in the air, like tariffs, which, of course, complicate that picture.
Yes, you do have tariffs and geopolitical risk, which was highlighted today, which we'll talk about in a moment. I've been watching the 10-year yield as well, because it continues to move down pretty dramatically here. 4.23%. Now, as we talked about a little bit yesterday, there are some in the administration who now are saying they're using this as a report card rather than stocks as a report card, and that lower is better. Well, if lower is better because of growth concerns, it's not necessarily better, but we're going to dig into that throughout the show as we see it here. I'm just looking at the 1-year chart here to show us that we're at the lowest since, I'll call it mid-December there. Yeah, you did mention geopolitics. I think we got to talk about that because obviously you saw Trump, Vance, Ukraine, Zelensky, and that meeting just implodes. I mean, we have really never seen something like that on camera in the Oval Office before, never, right? And so you could argue maybe some of that was telegraphed by some of the rhetoric heading into that, but obviously a shouting match, tempers flare, questions about what that relationship looks like ahead, if there is a relationship. And for a market that already felt fragile, now you raise these new questions about geopolitical concerns. Yes, absolutely. If you looked at the U.S. dollar here, a little bit of strengthening. This is the 1-year chart, but let's look at the day here. A little bit of strengthening. We saw some emerging market assets showing some trepidation during that meeting. But let's get the details on it, because I know our Ben Warshkel has been watching it closely. Indeed. President Donald Trump and Ukraine President Zelensky met in the Oval Office today, and things did not go as planned.
You're right now not in a very good position. You've allowed yourself to be in a very bad position, and he happens to be right about it. From the very beginning of the war. You're not in a good position. You don't have the cards right now. With us, you start having cards. But right now, you don't. You're playing cards. You're playing cards. You're gambling with the lives of millions of people. You're gambling with World War III. You're gambling with World War III. And what you're doing is very disrespectful to the country, this country. For more, let's welcome in now Yahoo Finance's Ben Warshkel. Ben, give us your reaction and response to that.
For sure, yeah. That clip kind of really tells you it all, but it was an incredible moment in the office that I think is definitely haven't been seen between a president and a sort of an ally in the Oval Office like that. What's also interesting about it is that clip came at the end of a 50-minute event that was friendly, largely, for 40 minutes. It was the last 10 minutes where things really went off the rails there, and it turned acrimonious after both Trump and Vice President J.D. Vance called Zelensky disrespectful and not kind of thankful enough for U.S. aid over the years. At another point during the back and forth, there was a line that Trump said, it's going to be very hard to do business like this. And I think that points to kind of the economic bottom line here, which is that this whole event, this whole visit today was to sign an economic deal that is now on the ice, for a time being. This was about rare earth minerals. It was kind of an agreement between them that would establish a fund that Ukraine would pay into to try to kind of tighten economic ties between the U.S. and Ukraine as part of the larger hope for peace negotiations. It's all on ice right now. That Zelensky left the White House soon after that. The deal has not been signed, I'm told, and it's very unclear what's going to happen to that. One of Ukraine's closest allies in the Republican Party, Lindsey Graham, was immediately out saying he doesn't think that America can do business with Zelensky. That's how kind of dramatic they're taking this. It's all up in the air, both the peace deal, the larger peace deal, as well as this economic deal, for certain.
Well, and of course, the whole paradigm of America's role as global peacemaker, as moral authority in the across the globe, is now changed, right? That it's more transactional, as we have talked about before with Trump in the White House. Ben, can you talk to us a little bit more about that turning point? Because for those of us who weren't watching the whole press conference, and as you said, there was 40 minutes of friendliness there. What made, what sort of turned it sour? What made Trump and Vance start talking about, Zelensky allegedly being unthankful? What do you think happened there?
Yeah, I think it was a sort of buildup over time. It was the first 40 minutes were friendlier, but not friendly, I'd say. Gotcha. What it points to me is the kind of limits of economic diplomacy you hear. Coming into today, the idea here was that by finding their way to this minerals deal, they could find their way to a larger deal because of how positive Trump talked about this. If you'd listened to Trump all week, this was a deal that there's some skepticism of this, but this was going to remake the whole Ukraine, be kind of a whole economic development model for the whole country that the U.S. would be closely involved in, and he was very invested in that, and he was friendly in that things. Where it changed was kind of these personal issues, where I think he's clearly unhappy with Zelensky. He doesn't like Zelensky very much. It's sort of evident from the video. And these sort of respect issues where Zelensky's not sort of solicited enough of him is what turned it against him. But it shows that sort of economic diplomacy only gets you so far when there's this kind of bad blood between these two leaders that's gone back to President Trump's first term.
Right, exactly. And Trump during that presser also talking about how Putin had sort of stood by him as there were allegations about Trump's connections with Russia in his first term. Ben, thank you very much. Appreciate your time on this. For more on the latest, let's welcome in Nancy Tengler, Laffer Tengler Investments CEO and CIO. And Nancy, obviously this is a very headline-sensitive market, right? And we haven't seen necessarily a lot of geopolitical reaction to various things, ex-tariffs. But the market did seem to take a bit of a hit as this press conference was happening. And I'm just curious to get your take and how you're thinking about the global stability, I guess, as you look at what's unfolded today.
Well, thanks for having me, Julie. I think a couple of things. I mean, the market is now rallying pretty hard into the close. I don't know what that means. I think one of the things that the market was reacting to was the Atlanta Fed downgrading GDP for Q1 to a negative 1.5%. When you dig into why that is, I think it has a lot to do with the tariffs and the uncertainty around that. And so what we're seeing is people, accelerating imports to the U.S. accelerating imports and exports declining somewhat. But the geopolitical part, I think will play out. I've been watching Twitter since President Zelensky was asked to leave the White House. And I don't know if this is true. I haven't had a chance to check it. But somebody in Ukraine in the legislature is calling for impeachment. So I do think that we will see a resolution, and it'll probably happen fairly quickly. I mean, I'm still recovering from that reality show. I don't know about you, but the whole thing made me incredibly uncomfortable, but point well made and taken, and so we'll see what happens.
It's interesting, Nancy, just as someone who's watched the markets for a long time, I'm just curious, given the range of issues right now, you have these growth worries, Nancy, that seem to be bubbling up. We've got a trade war. We seem to have these new questions about geopolitical concerns. How much confidence do you really have, bottom line, in the near-term outlook for the market?
Well, Josh, I think the market is going to continue to be choppy. Our expectation was the first half was going to be volatile, and then we would, as we got clarity around the tax bill, which apparently has passed the House at least, deregulation, where we are going with the tariffs, that we would then, have the decks cleared up for the headline risk, because earnings have been pretty decent. Guidance has been pretty decent. And my partner, Arthur Laffer Jr., actually believes that if we do go to reciprocal tariffs, that we will, that those will be deflationary instead of inflationary. So it is the uncertainty that is driving this volatility. And in the short term, it's always the algorithms and the hedge funds. Managers like me, I mean, we were adding to some of the tech names yesterday, and we'll probably be adding a little bit more to those names next week. We added to some of the infrastructure names, particularly around the electrical grid a few weeks back. So we're just going to continue to use volatility as our friend.
Nancy, I know that was Art, not you, who said that, but can you explain that to us? How are reciprocal tariffs deflationary?
Well, so think about our tariffs. Think about how our products are tariffed in other countries. If those tariffs were brought down, and then we brought ours down to that level instead of 25 to 30%, which are the numbers that are being bandied around, that would actually lower prices globally and also in the U.S. Now, we'll see. I think there's going to be a lot more jawboning around this topic, but I think companies have pulled forward a lot of their orders. We saw the ISM manufacturing numbers, which were very good for January. Expansionary employment rose, was also expansionary, and new orders rose. So if we are getting reshoring and onshoring, all this stuff kind of mitigates. If we get tax cuts, lower energy prices, it becomes it's a very complicated game at the moment. We saw that with the economic numbers. We had wholesale inventories increasing, retail inventories declining, personal income going up 0.9% versus expectations of 0.5%, but spending going down, and particularly real spending. So savings went up. So it takes time. You got to look at the trends because these numbers get revised so dramatically.
Nancy, I want to get your thoughts on some specific names. This week in particular, Nvidia, Nancy, they report, I think the street, by and large, financial analysts, thought the report was solid, thought the guidance was fine, but you saw that name get hit. I'm curious, Nancy, what you made of that report and that reaction.
I thought the numbers were great. I mean, and if you look at fiscal year expected growth and the guidance we saw, the stock or the company will generate over 50% in earnings growth. It's obviously decelerating, but there's also a huge backlog. And if you look at it on a multiple basis, it's trading at 23 to 26 times, depending on what time period you look at. And that's a PEG ratio of 0.5 times. And so that's pretty compelling for a company that's growing that pace. We added to it recently. We're going to probably add some more. I think this is the winning name. We exited AMD just the second. We thought that was going to be a compelling name just from the table scraps, but I think they've got some work to do on the product offering. And we still own Broadcom, and we've shifted our focus to the software names in terms of increasing our allocation because we think the inferencing aspect is going to be good for many of the software names.
Nancy, this also sort of speaks to the debate that seems to be playing out among some market participants right now about whether the pullback that we've seen recently is a momentum unwind or an actual sort of economic growth scare. And I'm curious how you have read it.
Yeah, I think it's a momentum unwind. I mean, go back to, I think it was the first quarter of 2022 when we got the negative, the 2 quarters in the first and second quarter of negative growth, and it turns out we didn't get a recession. I don't see a recession, at least if you're listening to the companies. And I do see increased use cases for AI, which is bolstering margins, earnings growth, revenue growth, productivity. So the monetization part is a little bit slower than expected. We heard that from Amazon, partly because they're supply constrained in terms of chips. So I think once we get through this Blackwell backlog and we start to see the companies really expand efficiency of their models, I think that is going to trump all of the other noise. And they've been selling off these stocks since DeepSeek, and I think there are a lot of questions around DeepSeek. And is it as good a model as we were told? And did they really produce it for $5.6 million? I think not.
Right. Right. Yes, definitely. There's been a lot of skepticism around that. Indeed. Nancy, thank you. Good to see you.
Thanks for having me.
We're just getting started here on Market Domination. Coming up, Nvidia shares making a slight comeback today. We'll hear from an analyst on the other side to discuss what's next for the chip maker and the chip market following its latest report. Also, crypto concerns continuing, the price of Bitcoin remaining below $85,000. We'll send you out to the Bitcoin Investor Conference later in the hour to get a pulse on that industry. Stick around, much more Market Domination coming up.
Nvidia reporting another earnings beat on the top and bottom lines this week, but now the attention is turning to tariffs as President Trump says he's imposing an additional 10% tariff on China next week. For more, we're bringing in Patrick Moorhead, founder, CEO, and chief analyst at More Insights and Strategy. Patrick, always great to see you. So let's talk about President Trump. He likes tariffs. He believes in tariffs, Patrick, as a policy tool. I'm interested to get your thoughts about how tech investors specifically should be thinking about that dynamic. I asked Patrick because I know that's a topic you've been thinking about.
Sure. So first of all, everybody needs to realize that Trump uses tariffs as a negotiation tactic. And he also wants to deliver on the promises that he made when he was running for president during the election. There's also some hysteresis going as well, where he did cut some deals in his first term that really didn't pan out, like China. So there's some memory there. It's very hard for the investor to play this chess game because the volatility is so high between no tariffs and 100%. I think he's just looking for the best deal. I think historically, what Trump has threatened versus what has happened is in the middle. And I know that's not very satisfying, but it is what it is. So if you're putting together your spreadsheets on impact, what I have seen though, Josh, is some incredible reactions in the supply chain. You know, companies like Dell, companies like Cisco, and the hyperscalers moving the different chess pieces around. But the one chess piece they cannot move is Taiwan, where most of the semiconductors are built, namely Nvidia, AMD, a lot of Intel, pretty much all of Qualcomm and Apple.
And there's no plan B for that, right, Patrick? You know, in other words, and to be fair, there's no development on that front right now in terms of China's relationship with Taiwan, in terms of U.S. relationship with Taiwan, and, you know, kind of its support for its traditional ally. But there, you know, we talk a lot about supply chains for different products and that there is a lot of diversification, right? Apparel manufacturers moving stuff to Vietnam or what have you. That hasn't, to be clear, that hasn't really happened with the chip industry, right?
In mass, it has not. TSMC did set up shop in Arizona. You have Samsung, who, you know, is building a giant facility here in my backyard in Austin, Texas. But these things take time. I could see a negotiated settlement where companies like TSMC agree to increase investment substantially in the United States without CHIPS Act money, albeit it takes 3 to 4 years from the shovel in or the design to pumping a chip out to get them to have the Trump administration not go through with those tariffs. So it's kind of a time-related element.
You know, Patrick, you know, obviously we all know how much tech is assembled in China. Outside China, you look at these alternative manufacturing locations. You think of India and Vietnam and Malaysia. I'm just curious to get your thoughts, Patrick. What are sort of the advantages, but also the challenges of those places?
Yeah, so when the pandemic hit, there were a lot of companies who got a lot more precise about their supply chains. We saw a tremendous amount of companies that used to do final assembly in China move those operations to Mexico, and all those ODMs like Foxconn added new facilities there. Vietnam, Malaysia, Indonesia, all are growth areas, but like we saw with China 20 years ago, there's a learning curve. There's a supply chain curve. And, you know, listen, when I was setting up factories 30 years ago with the Taiwanese to go through China, there were places that didn't have electricity, didn't have paved roads, and those things all need to come together. I think the wild card here is India, right? India is growing to be the next potential China, and you see a lot of companies diversifying their supply chains, but nobody is unhooked from China, right? Let's say they move 10, 20, 30% of it there, it's just very difficult. Even Mexico to the US, right? The average electronics worker gets paid around between $4 and $5 in Mexico, compared to an average of about $20 here in the United States. So you're going to pay somewhere, and where you move those flexible supply chains, I think, will be dependent on what the tariffs versus the costs are.
As you say, this is all pretty long term. Let's talk a little bit shorter term. We got Nvidia this week. We're getting Broadcom earnings next week. And the reaction in Nvidia was obviously quite interesting, given that there was nothing sort of intrinsically in the numbers that should have triggered the reaction that it did. So does that tell us anything about what to expect, not just from Broadcom's numbers, but sort of from the reaction also?
Yeah, and this might sound a little jaded, but in this area, a meet is a miss, right? Nvidia had a triple beat, which it looks like people kind of viewed it as a meet. People are looking for a reason to get out of these types of tech stocks versus stay in. Part of that is the giant run up. But here's the thing. Demand should not be in question for Blackwell. Mag 7 CapEx of $325 billion remains. I think Blackwell is sold out. NVIDIA is indicating it is. TSMC says it's sold out for calendar 2025. And then the only question that's coming into play here is if it can deliver as many as it needs, if the tariffs will impact it, which you and I talked about already, and how long the run can go on. Listen, it's hard to make a confident case beyond calendar 25 that the rate of growth continues. We've already seen a expected deceleration in the growth rate.
Final question, Patrick. Let's spin ahead. Broadcom reporting earnings next week. I'm curious to get your take. What do you think we're going to hear from Hock Tan's company?
I think we're going to see similar growth rates in terms of acceleration versus NVIDIA. And the reason is because they have this accelerator business that they keep adding customers to. That's a play for them, but also the networking that goes along with this. While NVIDIA does have its own networking solutions, the primary breadwinner of all of this GPU goodness is Broadcom. So as NVIDIA grows, so does Broadcom. And let me be very specific. It won't be the exact percentage growth rate, but an acceleration of what Broadcom has been doing in the past.
Patrick, always great to see you. Always great to have you on the show. Thanks for joining us.
Thank you. Have me on.
Stick around. Much more market domination still to come. Economic negotiation between President Zelensky devolving into a contentious conversation earlier today. Let's go now to Yahoo Finance Executive Editor Brian Sozzi live at Bitcoin's investor conference with Skybridge founder Anthony Scaramucci. Brian.
All right, thanks so much, Josh and Julie. Appreciate it very much. Yeah, so this room is a buzz of all things Bitcoin, but Anthony, first of all, good to see you.
Good to see you.
Appreciate you coming on, man.
It's less cold here.
Yeah,
than
less
it was
cold
in
than
Davos.
World Economic Forum. Yes, you had to have seen the exchange in the Oval Office between Zelensky, President Trump, and J.D. Vance. Your thought on that?
Well, listen, I see it very differently than Donald Trump and J.D. Vance. The Russians were the aggressors. The Ukrainians had a democratically elected leader that repelled them and did the bidding of Western Europe and the free world by repelling a dictator from invading a sovereign nation. And so it felt like a setup to me. It felt like they brought him in to rough him up like that, I guess, to humiliate him and get him to resign because he's a very strong leader. The expectation was 3 years ago that he was going to leave. Putin was going to take Kiev in weeks, and they've been fighting it out for 3 years. And so, I applaud Zelensky, President Zelensky, and I just think it's a shame that the United States is going in this direction. So I'm not a fan of what happened, but I understand what they did to him. It was a propaganda setup, frankly.
You've worked with this president. You've been this close to him. What is he thinking in terms of why is he warming up to Putin?
None of us could figure that out. Whether it was me, McMaster, John Kelly, none of us could figure it out. And I'm not saying that President Trump is an agent of Vladimir Putin. None of us say that. But if he was, you would go down the list of what he is doing and you would do those things. You would go after the Canadians, our longstanding allies. You would attack the Mexicans. You would say that Panama needs to give back the canal. You're going to take Greenland. What he's doing is he's trying to set this up so that there's a multipolar world. Maybe there's an American pole to the world and a Russian pole to the world and perhaps a Chinese pole to the world. And that's sort of a change in direction from the free world protecting itself and drawing multilateral alliances and trade agreements among themselves to make themselves safe. And what I would say is that there are 5.7 billion people on the planet that are living under some form of autocracy right now. And what they got from the United States was a country that believed in freedom and was trying to push freedom. And just compare this to Ronald Reagan as an example. He's meeting Gorbachev in Moscow. The State Department says don't stop to meet the Jewish dissidents, but he stops to meet the Jewish dissidents to send this message. And so the message that's going on today, I think, is antithetical to what America has represented. Now, if you're telling me this is the direction that America wants to go in, and we're a democratic country, if that's the message, we want to go in that direction, that's fine. But I would represent the dissent of that. I would say that that's a bad direction for America. It's going to be bad karmically. It's going to be bad for our alliances. It's going to be bad economically.
And is it bad for investors? And I bring that up because we saw markets trade higher into this president's re-election. We have tariffs now. Anthony, I was on I did an interview with HPCO, Enrique Lores yesterday. He might have to raise prices because of tariffs on his computers. We have tariffs. We have the spectacle in the Oval Office. How could investors not fear this president?
Look, it's very bad. But look, the market's telling you that, Steve Cohen, a good friend of mine, I'm an investor of his, he said it last week. Remember, tariffs are a tax, and they're primarily a consumer tax. It's a consumption tax. It's sort of like a VAT, and that's a regressive tax. And so what ends up happening is the poor people, it eats up more of their disposable income than any other income group, and it's very harmful. It creates a negative flywheel, a vicious circle in the economy. So again, I understand that we need to manicure and surgically go through our trade agreements and reset some of them to protect American workers, and I'm all for that. But I don't think this sort of blanket approach is the right way to do it, and I think he's going to put us into a recession, frankly.
we've seen recession probabilities pick up. Our shows have been talking about it all day long. Are they right? Are economists right to worry that this president puts us into a mild recession?
Look, I mean, you got some room. The Fed could cut rates and create more liquidity in the market if we're really going to go into a recession. But it feels like that. He didn't need to do any of this. You know, the economy was doing quite well. He could have surgically applied some tariffs. He could have, if he didn't like certain things. Remember, he himself did the trade deal, redid the trade deal with China, redid the trade deal with Canada and Mexico. If he didn't like elements of it, he could have gone back to them and tried to tweak it. But going about it the way he's going about it, you know, he's got the Canadians talking to the Chinese now about selling their energy. You know, I don't know. I don't think that's in the best interest of the United States.
Lastly, of course, we're at the Bitcoin Investor Week conference. I've talked to folks in this room. People are optimistic about a Bitcoin reserve, stablecoin regulation. They think the administration is going to be friendly to crypto. But given everything else we're seeing, Anthony, does the crypto community, are they going to get a wake-up call that maybe the year goes by and none of these things happen?
Well, I mean, there's a chance of that, but I think even if the worst case happens, the one that you just described, the fact that there isn't a jihad against the crypto community, I think is very good long-term for crypto. This macro stuff, though, is not great for crypto. You know, just remember this with Donald Trump. You get the whole buffet table. You get the meme coin grift, you get the 51st state for Canada, the acquisition of Greenland, Zelensky's a dictator, and oh, by the way, while you're at the table with your tray, you can pick up a little bit of pro-crypto regulation. But he's going to force feed you everything on the Trump buffet table.
We're going to leave it there. Skybridge founder Anthony Scaramucci, always good to see you. Appreciate
Great to
it.
be here, man.
Thank you. Appreciate it. All right, guys, back to you in the New York City studio.
Sas, thank you. A little buffet table there. The Federal Reserve's preferred inflation gauge cooled as expected in January, but that bit of good news came with a dose of bad as consumers pulled back their spending by the most in nearly 4 years. Joining us now is Shelly Antonevich, Investment Company Institute Chief Economist. Shelly, thanks for being here. So we've been talking about today not just the PCE data and the spending data, but the fact that the Atlanta GDP nowcast, their sort of compendium of all the data, is now showing a potential pullback in first quarter GDP. Do you think that's just temporary, that once we get more data, that we'll see slowing but still positive growth for the first quarter?
Well, Atlanta Fed GDP forecast right now, or nowcast right now for the first quarter is negative 1.5%. And it had been just a couple weeks ago, 2.3%. So the incoming data today from the Census Bureau on advanced international trade deficit showed a 25% increase in the international trade deficit. And that's coming from a surge in imports into the US. Now, is that trying to get ahead of the potential tariffs? Maybe. You know, we don't know the answer to that. Is it just a snafu in the supply chain from winter forecast, winter sort of issues? So, you know, but that is data that has come in, that is feeding into GDP. Now, in order to reverse that, we're going to need a lot more consumption growth, but yet the PCE forecast, the PCE data, on the other hand, that came out today showed a 0.2% decline in consumer spending in January. And we've seen that consumer confidence fell quite a bit in February. So the signs of the consumer, which has been holding up sort of the fabulous and wonderful GDP growth that we've experienced, the resiliency in the US economy, that could be starting to falter.
So Shelly, based on the incoming data we're getting, including PCE this morning that you mentioned, what does that suggest to you about the Fed's possible next moves, both near and kind of intermediate term here?
Well, the Fed right now, if you look at the market, Fed funds futures, and what the probabilities of Fed cuts are saying, so what the market thinks the Fed is going to do is that there will definitely be a cut. There's almost near universal agreement that the Fed will drop the funds rate about 25 basis points in June. There is, again, near universal agreement that the Fed would follow on with another 25 basis point cut in September. And the odds are pretty high, about 70% for a third cut in December. And that's different. That's different from just a few days ago where there was only 2 cuts built into 2025. Now the market is expecting 3 cuts. And the Fed could very well follow through on that. They've got, the direction of inflation according to their preferred measure, which is the core PCE measure, is coming down. As long as it continues to show sort of signs of slowing, that is going to be something that is, a check the box for them. The other side of it is you do have uncertainty in the labor market right now. One of the policy goals that has been stated is a significant reduction in the federal workforce. 10% target. A 10% target on 2 million people is 200,000 people. How quickly those people are absorbed into the sort of private, workforce and the disruption that could cause, that also could have an impact on GDP. And that's going to be something that the Federal Reserve will be watching carefully because they do have the dual mandate of employment and inflation.
And Shelley, we've been talking a lot about tariffs here on the show. A lot of the investors we speak to see them as a bargaining tactic, don't necessarily think that they will go into effect fully, or at least not for a long, some extended period of time. As an economist, how are you trying to model out what effect those tariffs could have?
Well, certainly I'm also of the opinion they're being used as a negotiating tactic, but if I were running a major corporation, I wouldn't want to go with that. I'd want to make sure that I was hedged against a possible increase or for the imposition of tariffs. Maybe not 25%, but 15%, 20, 10%. Even that is going to have an impact on my company's bottom line. So I would definitely want to make sure I'm hedged against that, where the exposures are, and what I can do in the near term to mitigate that.
Shelley, final question. We talked about tariffs. What about Doge, Shelley? Elon Musk certainly seems determined to cut. I'm curious how, as an economist, you try and think through the possible economic implications of that effort.
Well, as I said, if you think about it, the objective is to reduce the federal workforce. So how that's done, and it could be done in a way where people are slowly let go, or they have severance packages, they have time to find another job, they're not worried about making their rent or their mortgage next month, or their car payment or their credit card bills. So there are ways that this can be done that would have minimal disruption. Mass unexpected layoffs where people haven't really been able to financially prepare for that would have a much larger shock.
Shelley, thanks a lot for your perspective. Appreciate it. Let's get to some of today's trending tickers now, and we start with DoubleVerify. The ad tech company stock is plunging, and this is after it posted weaker than expected numbers for last quarter here, and the company also came out notably with a first quarter adjusted EBITDA forecast that was short of estimates. It said it didn't get the post-election ad sales rebound that it had hoped for, Josh.
Yeah, I'm just trying, since you're on a day like this, you kind of see what some of the analysts are having to say about it. What do bulls say in particular? Truist has a buy on this one. They were telling clients results, they say weaker than expected. Company, they say prudently tempering expectations for 2025. They argue short-term headwinds, yes, but positive long-term thesis remains intact. So
well, if you look at the stock over the long term, I noticed that last May, the company cut its forecast, and the stock fell nearly 40% in a single day. You see it very clearly on the chart there on the left side of the chart, and it just never really recovered from those levels. It just kind of went sideways from there. So it's now down about 65% over the past year, if you include the selling that you're seeing today.
Our next trending ticker, let's take a look at Archer Aviation. Those shares surging today after it disclosed that it intends to provide aircraft this year to a commercial customer, Abu Dhabi Aviation. That stock popping despite the company reporting disappointing numbers in its fourth quarter earnings. So Archer was interesting. So, interesting, maker of electric aircraft that sort of take off and land vertically, reports larger than expected adjusted loss per diluted share for Q4, loss per share of 44 cents. Estimated was loss per share of 28 cents. Needham has a buy on this one. Business momentum, they say, combined with a steeply discounted valuation versus their closest peer creates a margin of safety, they said.
Yeah, and this is, I believe, the only publicly traded pure play eVTOL company, if I'm not mistaken, electric vertical takeoff and landing. Is what these do. An electric helicopter, basically, that wants to be an air taxi eventually and provide that kind of a service. So, there's part of that this is the only way to play this kind of a thing. So even though you get these numbers, the bet is that with that Abu Dhabi contract and other stuff coming down the pike.
Yeah, and what a run for the stock.
Yes, most definitely. The stock is up a lot. All right. Our next trending ticker is Fubo TV. That stock is down double digits today after it delivered mixed fourth quarter results and provided lower than expected first quarter revenue guidance. It also predicted its subscriber base will fall during the current quarter. Of course, we are awaiting the deal that it is doing here with Disney. Disney going to merge Hulu, Live TV, Fubo, putting it all together here. So this, it's unclear how important this quarter is compared to what people are
bigger
looking
picture, you're
to.
saying,
Yes,
Julie.
yes.
Our friend Michael Pachter at Wedbush, friend of the show, here's what Michael told his clients about this. He said, Fubo management appears content to slow the pace of subscriber growth as it focuses on profitability. To your point, he says, this suggests to us that management confident that its merger with Hulu plus Live TV will close and it will be in a very strong financial position. That, according to Michael Pachter.
Well, he knows. In the Yahoo Finance podcast, Financial Freestyle host Ross Mack discussing wealth building journeys and what it takes to create a lasting financial footprint. You can scan the QR code below to stay up to date with all the latest with that podcast. And be sure to tune in to Financial Freestyle every Monday at noon Eastern. Here's a clip from the latest episode.
Let's talk about the growth of esports and what made you interested in this sector and obviously taking over as CEO of PlayVersus in 2023.
2023. So I've been the CEO for about 18 months.
Nice.
And we're really proud of what we've been able to accomplish. Our mission really is to provide, to make esports an officially sanctioned sport. Just like getting financial literacy approved in states, we're on a mission at PlayVersus to make sure that esports becomes an officially sanctioned sport in every state in our country. Right now, we're happy that in 27 of the 50, it is.
Wow.
Where a young person can earn a varsity letter, can compete for a state championship in an esports title. So it could be in Mario Kart, it could be in League of Legends, it could be in Rocket League, it could be in Madden. These are all exciting opportunities where kids who are on an esports team, they're again, earning a varsity letter, winning a state championship, hoisting the same trophy that a traditional sport like football or basketball are hoisting. So it is, we continue to try to get as many participants as possible. And one of the things that also inspired me at PlayVersus, which relates to my experience at EverFi, is I really saw when I started that in order for esports to grow and continue to be legitimized and be a sanctioned sport, we had to eliminate all barriers to participation. So one of the unique things about the EverFi business model is we gave our learning platform away for free to schools. We got organizations who cared about supporting things like financial literacy to essentially underwrite the cost of bringing that to the schools that they cared about. We've now done the same thing at PlayVersus. We've completely eliminated all competition fees from any school who wants to participate with us across the country. And we started a journey at the beginning of last year to assemble an ecosystem of partners who care about helping kids get involved in PlayVersus. And part of the reason they should care is that esports today gives kids, many kids, a purpose that they didn't have before they started to compete with us. Almost half of the students who play on one of our teams, this is the first extracurricular activity they've ever done.
Wow.
So you're literally pulling them and giving them purpose. I got a message just yesterday from a teacher. We just launched Marvel Rivals, which, if you don't know, is one of the hottest video games amongst teenagers today.
Nice.
And she said, I can't thank you enough for introducing Marvel Rivals to our platform, because the 3 kids who just started the esports team used to sit by themselves at lunch.
Wow.
With not a lot of friends. And now they've got a new purpose.
Time now for our call of the day. Cava Group shares higher today after Piper Sandler raises the Mediterranean chain to overweight. So they are new fans, Julie. One of the best ways to invest in the growth of the fast casual restaurant industry. Cava, they say, best positioned companies are coverage to navigate any environment. Says they've raised prices less than some others in recent times. Cava, what a run, up about 65% over the past 12 months.
Yeah, remember, this is one that went public not that long ago. It went public back in 2023 at $22 a share, and now it's trading just shy of 95.
Mm-hmm.
So over the period of time, obviously it's done pretty well before a more recent little bit of a pullback here.
Right, I should mention that because you bring up the chart. They are up around 65 over the past 12 months. It is interesting, not a great 2025 so far. They're down
it is not.
Down there like 20% this year.
Yes, they are. And although, the price target here, $115, and the stock is sort of mixed between buys and holds, 10 buys, 8 holds, no sells on the thing. So
Piper says buy it.
Yes, exactly. So going up a little bit today. And shares of Walgreens are lower today after Deutsche Bank downgraded that stock to a sell. Analyst George Hill writing that the deal with Sycamore is, quote, unlikely to be consummated at a premium to the current share price. So interesting here, there's been some renewed talk. The Financial Times most recently talking about Walgreens and Sycamore doing some kind of a deal, but it would be a take private, but it would have to sort of split up the company. Mm-hmm. And Hill is essentially saying it would be very difficult to value the different pieces of this company. He says it would be confusing to investors because some of the assets are in Europe, some are in the United States, and so that's one of the reasons that's behind the downgrade.
Here's the money line to me. You know, it
Yes,
wasn't
tell me.
known. I think it was this. We recognize that it will be controversial, he told clients, to downgrade a stake in the midst of a take-private discussion before a deal has been announced. But he says we have seen this scenario before in the healthcare space where deal reports have driven the share price to overshoot what a sponsor is willing to pay, and we believe this is the case with these shares.
Yeah, he says the sum of the parts is just hard to square.
Sell it, target goes to 9.
Yeah, exactly.
While we are wrapping up today's market domination, don't go anywhere. We've got you covered with all the action. Follow the closing bell. Stay tuned for market domination overtime.
Welcome to Yahoo Finance Sports Report, a unique look at sports business brought to you by Yahoo Finance and Yahoo Sports. I'm your host, Joe Pompliano, and I'll be breaking down the financial side of the game for your financial gain. We'll go beyond the headlines, analyzing all the latest sports news, the teams, the trades, and billion-dollar deals, so you and your portfolio will win big. Catch Yahoo Finance Sports Report on Thursdays on all your favorite podcasts and streaming platforms.
There's the closing bell on Wall Street, and now it's market domination overtime. Jared Blicker going to be along in a moment to get you up to speed on the details from today's trade. I'm going to start with the major averages. buying into the close. Look at this. We haven't seen this in a little while, right? What we've seen the last couple of weeks is selling into the weekend. Now we've got a little bit of buying here that's sending the Dow to close at its highs of the session, up by 600 points, about 1.4%, and most of that turn upwards coming in the last half hour or so of trading, whereas there's been a lot of volatility triggered by tariff comments over the past couple of weeks or so. There has been some reporting today that Mexico might be willing to match U.S. tariffs on China itself as a way to get its own deal, to avoid its own tariffs. And so perhaps that's something giving the market, heartening the market, perhaps into the weekend. Maybe it's just taking momentum back on. Who knows? But we got the S&P 500 up by 1.6% on the session, and we got the Nasdaq up by 1.6% as well. Is it enough for things to be positive on the week? No, not for the Nasdaq, but I'm sure Jared's got to look at all of the numbers as well under the surface. Hey, Jared.
Well, hey, Julie. Yeah, sometimes at the end of a big month when you've had a big decline or a big gain, you can see some interesting action into the close, and I think that's what we saw today. Some really big funds had to do something, and that it could be as simple as that. Let me show you the 19-day, and that's going to be for the month of February. Nasdaq Composite down 4%. That's going to be worse since I believe sometime in last year. Without that stick save into the close, it would have been worse since 2023. Taking a look at the S&P 500, down 1.43%. It's not a disaster, but it's still a negative return, something we haven't been used to much of in this bull market. And then the Russell 2000, that's down about 6%. And let's round it out with the Dow, down about 1.5%. Moving on to some of the sector action and some of the heat maps here. This is the Nasdaq 100, and you can see what a nice close that delivered for us. Nvidia up almost 4% there, but we want to get a look at the sector action. All 11 sectors in the red, led by financials and consumer discretionary. I think it's notable that consumer discretionary was the worst performing sector in the month of February, or yes, it was, down 7%. You can see that down in the lower right. Consumer staples, kind of its opposite, maybe its cousin. That was number one, up 5%. Real estate and energy, number 2 and 3. And taking a look, let's look inside the Nasdaq for a month-to-date look real quick, and you can see some of the carnage that we had in some of these big guys. Nvidia eked out a gain, so did Apple, but Alphabet down 16%, Tesla down 28%. For some of these names, and I believe Amazon down 10%. That was the worst for Amazon and Tesla since December of 2022, and that extends to the entire Mag 7 index. So Amazon and Tesla really kind of gumming up the works for the Mag 7 there. I'm going to close on a potential another bright spot. That's going to be China. Alibaba up 34%. And Josh, you and I are going to get into this in about 30 minutes, some of the deep dive details.
We sure are, Jared. It was a roller coaster day on Wall Street after a contentious meeting between President Trump and President Zelensky. But stocks did rally into the close, this coming amid a backdrop of growing concerns of slowing economic growth, as the latest Atlanta Fed GDP Now estimate shows contraction in the first quarter. Joining us now is John Che, Cohen & Steers President and Chief Investment Officer. John, it's good to see you here on set.
Josh and Julie, thank you so much for having me here today.
Let's talk, John, about this new macroeconomic regime you talk about. So here's what you say, John. You say stubbornly higher inflation, slower real growth, and higher volatility. That doesn't sound so great, John.
I'm sorry to break the news to you here today. Well, look, first and foremost, our view is investors need to have things like listed real assets and alternative income in their portfolios because it helps offer returns, but also diversification. So this gets at this idea that the future, unsurprisingly, is going to be different than the last 5 or 10 years that we've lived in. It may not be a very fun story, but just like the volatility that we've seen here today, whether it's talking about geopolitics, supply chain, tariffs, and things like that, it's a new game. And policymakers, instead of saying inflation is low, let's just grow the economy, now policymakers have to worry that inflation is higher than they want it to be, that geopolitics and supply chains are becoming very important considerations. So our view is for policymakers and therefore economies, it's just a much trickier game. So what does that mean for investors? It means that even though, of course, everyone thinks they have the right answer, you need to be diversified. And areas like real assets, so those are things like real estate and infrastructure, They go in cycles, just like things like equities have gone in cycles or private equity have gone in cycles. So over the last 10 years, certain areas have had a lot of tailwinds, but then certain areas, frankly, have not done as well, and as a result, valuations have become more attractive. So, as an example, in that kind of new regime, we know equities have done really, really well the last 10 years. That's great, but the more likely outcome is over the next 5 to 10 years, equities may disappoint. And so that means we need to have other asset classes that can help deliver returns. And so our view is an area like real assets could be one of those areas to be part of the diversification.
Now, John, I may be wrong, but I'm guessing that you always think real assets are good, because that's what you guys do, right?
Sure.
So I guess if you can expand a little bit on the role that they should be playing now versus the role they perhaps played in a portfolio over this last 5 years or so when we were seeing stocks really perform.
Sure. So real assets generally, they're going to tend to do well when inflation is going to be a little bit higher. Also, sometimes when the economy is a little bit more, I wouldn't say poor, but I would say less certain, because areas like real estate, but also in particular infrastructure, these companies, they own hard assets and they have what are called contracted income, whether it's a 10-year lease or you're a utility company where I would say the earnings volatility is relatively low. And so in a world where inflation may be a bit higher and where maybe the view of what's GDP going to look like over the next 6, 12, 24 months may be more uncertain, those are typically, that's typically an environment where real assets tend to do better. The last decade, we were in a low inflation world. And so, of course, that wasn't a great environment for things like infrastructure, things like real estate, and things like natural resource equities. So that's why we think we're in a different kind of world. And in that different kind of world, you're going to want to have these kinds of asset classes.
So John, for viewers who are listening right now, they're thinking, John makes a lot of sense. I got to tweak my portfolio here. I'm thinking about REITs, and obviously, what you guys know it better than anybody. What is the REIT outlook for 2025? What do you see?
Sure. So over the last 2 years or so, REITs have done, let's just say, roughly 10% a year. Mm-hmm. Most of the time, you'd say that's pretty good, except for the fact, of course, that the S&P's done 25% a year. Mm-hmm. I would say going forward, we feel earnings growth is actually accelerating for the REIT sector. The biggest reason for that is because new supply. So new supply, and you probably have people, coming here on the show saying it's hard to build new office buildings or it's hard to build new shopping centers. And frankly, tariffs don't make that any easier. When things become more expensive to build, that's bad to be a developer. It's good to be an owner of real estate because that means there's just less new competition. So we've seen new supply come down, and that's why we're seeing accelerating rental growth and income growth. So I'd say that's really the big story for the real estate sector.
Well, and REITs are not all created equal, right? Within real estate investment trusts, you've got everything from companies that own wireless towers, right? Cell phone towers, to office buildings, to apartments, to shopping centers. Is there one area that you think is really going to outperform in this environment?
Well, first, that's a great observation. A lot of times people think that the real estate sector is just about office. So the first thing is the office sector these days is only about 3% of the REIT sector. People are surprised by that, but that's because just like the equity market, the REIT market reflects the future of what we need in real estate. So senior housing, for example, is a big area that we like. Of course, we all know we're all getting older, whether we like it or not. But senior housing, these are businesses that are not reliant on Medicare or Medicaid. This is all private pay. And of course, we are entering baby boomers. Again, we're all getting older. They're entering I'd say the peak years of entering into senior housing. And coupled with that, we haven't seen a lot of new supply. So when demand's getting better, again, it's not a cyclical thing. Everyone's getting older. When demand's getting better and we haven't had a lot of new supply, senior housing is an area we like. So healthcare REITs are more than 10% of the REIT universe versus, again, the 3% I just mentioned for office.
Yeah, great perspective. John, thank you so much for coming in. Really good to see you.
Thank you so much.
Well, Americans voted against the Joe Biden economy in 2024 with inflation and the perception of Democratic ineptitude clinching Donald Trump's presidential win. Just 1 month into Trump's presidency, however, Americans are gloomier than they were at the end of Biden's term. Joining us now, Yahoo Finance's Rick Newman, who wrote about this in the latest edition of Trumponomics. Good to see you, Rick. So I guess the Biden economy is looking a little bit different now.
Be careful what you ask for, I guess. Well, I mean, if you look at just a bunch of different measures we've seen in the last couple of weeks, consumer confidence now back down to the levels of last June or so, investor confidence down to levels of 2023. I mean, it's striking that after Kamala Harris of the Biden-Harris administration lost in November, we did see a little spike in consumer confidence. We know all along that voters gave Trump and Republicans in general higher marks on handling of the economy. But now we're only a month into the Donald Trump administration. I guess we're into the second month now. And we're seeing the marks going back down to where they were at pretty ugly times during the Biden administration, such as when inflation was raging. And this is happening as we're actually seeing not just strains on sentiment, but also what might be some actual cracks in the economy. We've been talking about this a lot this week. Jobless claims are up. That coincides with Trump trying to fire all these federal workers. Maybe not a coincidence. How high do we really want unemployment to go? We're now seeing weak spending numbers. Some economists now predicting that we're going to have negative GDP growth in the first quarter. This is not random. A lot of this has to do with what we've been talking about incessantly, which is Trump threatening to impose tariffs, actually doing it in some cases, trying to kind of demolish the federal government, deport migrant workers. And this is having an effect on the economy. I mean, it is clearly starting to show up. So I think what markets want to know is how far does Trump really want to go here? Because right now we're in a game of chicken between Donald Trump and financial markets, and Donald Trump is showing no sign of slowing down.
Well, it's interesting, Rick, because there has been obviously this perception when you look at the survey data. The Democrats are a lot more worried about the economy right now than Republicans are. And so some economists have, I guess, taken those readings less seriously, perhaps because of that. How are you thinking about that disconnect that we've seen, which obviously is a absolute flip-flop of what we were seeing before the election?
Yeah, right. So there's a political bias. It's now very obvious. There's a political bias in the way people view the economy, whether you're a Democrat or Republican. But the people who determine elections are not really Democrats or Republicans anymore. They're independents or people in the middle. That is also a very important voting bloc, and those people show up in surveys. And for the most part, they're not as gloomy as Democrats, but their sentiment is getting worse, not better. So if you just kind of call that the middle is getting gloomier too. And I think the thing that we really need to be paying attention to is when consumer sentiment, which is fickle, but when that actually starts to align with what we see happening in the economy and also with business sentiment. I mean, we are hearing from almost every direction at this point that businesses are putting investment plans, spending plans on hold. They're putting hiring plans on hold. Totally logical as you wait to see what is going to happen with these Trump tariffs. Are we going to get through just a period of sort of fanatical threats, and then it'll all kind of settle after 6 or 8 months, or is this just going to go on for the next 4 years? The U.S. economy, it's a remarkable engine, but it's fragile on the margin. And these sorts of things that Trump is doing, they are going to make a difference, and they're starting to show up, and they're showing up quickly. I mean, just for what it's worth, Trump's approval rating now is lower than Joe Biden's was at the same point in his presidency, and it has also fallen faster than Biden's approval rating. So maybe Trump doesn't care. Maybe he feels like he's king, but a lot of the rest of us care.
All right, Rick, thank you so much. Have a great weekend. Appreciate it.
Bye, guys.
Coming up, it's What to Watch next week. We're going to get you set for everything you need to know to better position your portfolio. Stick around. Much more market domination still to come.
A Senate banking subcommittee held its first hearing exploring what a legislative framework for digital assets should look like. That happened yesterday. And that hearing was led by Wyoming Republican Senator Cynthia Lummis. She's a longtime crypto proponent and investor. And I spoke with Senator Lummis earlier today from that Bitcoin Investor Week conference. First, I got her take on the crypto environment right now, including the recent sell-off we've seen in Bitcoin.
It's not unusual for assets at this point in time after a change in presidency to pull back. It happens with stocks, bonds, oil, and other assets. So it's very typical in February after a new president takes office for there to be a slump. And so Bitcoin is participating in that slump. What will surprise me is if in the weeks to come, it does not recover. So I expect to see some recovery, certainly in the second quarter of 2025.
I do want to talk about yesterday's hearing because I'm curious if you agree with former CFTC Chair Timothy Massad, his testimony that sort of a legislative overall digital assets framework is less urgent than a stablecoin framework. Why would that stablecoin legislation be so urgent, and what's the status of it?
We will be moving stablecoin legislation first in the U.S. Senate, and then we'll move to market structure. The reason is stablecoins are the more plain vanilla asset, so we need to start with something that is backed by treasuries and agencies, and stablecoins are 100% hard asset backed by mostly fiat assets. We want to start there because when we move into market structure and later into other opportunities for Bitcoin, we have gotten a win under our belts legislatively.
And what about a Bitcoin reserve legislation? Because in your home state of Wyoming, for example, legislators rejected a state reserve. They were concerned about volatility. How do you sort of control for that if there's to be a federal reserve?
Well, we need to help people understand that short-term volatility is going to happen with Bitcoin. It always has. The goal of a strategic reserve is to buy or convert current assets into Bitcoin and then hold them. So the plan is acquire $200,000 worth of Bitcoin over 5 years and hold it inviolate for 20 years. That way, we can remove the short-term volatility from the equation and look at this as a long-term strategic asset and not something that can be rated for use in runaway profligate congressional expenditures and will be there for the long run 20 years hence.
And Senator, what kind of feedback are you getting from your colleagues on the Hill? Have you seen an increase in support for the idea?
Well, we've got more work to do. There is a favorable administration. President Trump has expressed interest in having a strategic Bitcoin stockpile. His administration is favorable to the notion. We have some work to do, both in the U.S. House and the U.S. Senate, in helping people understand the reasons why we should have a strategic Bitcoin reserve and how does it interplay with the world reserve currency status of the U.S. dollar. We think they're very complementary.
Do you think there should be any other types of crypto assets in that reserve?
Well, for my 2 cents worth, I'd like to have Bitcoin be the underlying strategic digital asset. We know that It can be held safely in individual wallets or by custodians. We know that it doesn't require a board of directors for verification. We know that it's fully decentralized. We know that it is an asset that will only have 21 million ever made. So its scarcity will give it value. Some of those criteria for what constitutes digital gold don't exist in other digital assets. So we need to be careful when we have a strategic reserve to be able to check the box in what's important in having a long-term strategic asset. And I think that some of the elements of Bitcoin are a perfect fit for a long-term strategic asset.
I also went on to ask Senator Lummis about the White House's effort to cut spending and whether Elon Musk's approach to cut costs has been too aggressive.
To Elon Musk about this, we know that the work of Doge is to ferret out waste, fraud, and abuse. They're making tremendous progress. It's so impressive. The people on Doge that are in these agencies are federal employees. They've been vetted the same as any other.
That's great. You've talked to the Doge people. What about to your constituents in the state, though, who are losing their jobs? Have you talked to them?
Yes, I have. And here's what's happening. The short-term employees that are necessary to make our national park experiences enjoyable are going to be hired. There's going to be no change in the summer short-term employees. There's going to be no change in the number of firefighters and essential service providers. So it's going to be more the bureaucratic arm that will be affected by cuts, not the people that are front and center serving the visitors. So the visitor experience will not be affected.
And undoubtedly there is waste in the federal government. I think there's broad agreement on that. I think the perhaps quibble, if that's not too light a word, that some of the American people have with what Doge has been doing is that it's applying a chainsaw rather than a scalpel, that it is doing bigger cuts to broad swaths of programs, USAID, for example. What concerns, if any, do you have about that?
Yeah, and let me tell you why it has to be that way. There are union contracts that protect federal employees from scalpel-like or more strategically placed cuts. So Doge can't do it that way pursuant to contracts the federal government has with unions. The only way to reduce employees is the machete approach.
My thanks to Senator Lummis, who obviously was doing heroic work there, trying to hear me in a very loud conference.
All right, time now for what to watch next week. Starting off on the economy, President Donald Trump's 25% tariffs on imports from Canada and Mexico are taking effect on Tuesday. Trump citing the levels of fentanyl coming in from both countries as the reason for the tariffs. Additionally, Trump saying yesterday he is imposing a second 10% tariff on China.
Speaking of the president, Trump is also addressing a joint session of Congress on Tuesday, marking the first major speech of his second term. This coming after President Trump's meeting with Ukrainian President Volodymyr Zelensky today. What started as an economic negotiation wound up devolving into a heated exchange, leaving a potential mineral rights deal in limbo.
And moving over to earnings, it is another big week of earnings on the horizon, including CrowdStrike, Broadcom, and Costco. Costco announced results for its second quarter. That's on Thursday. Analysts expecting the company to post solid same-store sales growth driven by a strong holiday season.
And finally, February's full jobs report, it's coming out on Friday. Economists forecast 158,000 non-farm payrolls were added. That's an increase from January, while unemployment holds steady at 4% and hourly wage growth expected to slow to 0.3% on a month-over-month basis.
Now, between Nvidia earnings and key economic data, it's been a busy week here at Yahoo Finance. Here's a look back at the week that was, in case you missed it.
Q4 was another record quarter. Revenue of $39.3 billion.
I'm more enthusiastic today than I was at CES.
I thought it was a good report. I thought it was a good call overall.
It looks like demand remains very, very strong.
This is a fantastic quarter from a company that is performing fantastically.
This is a decisive moment for NVIDIA. The technicals are saying we need a catalyst of some sort.
The IRS is cutting over 6,000 jobs in the middle of tax season.
Musk is clearly kind of entering a new phase here.
What the government is focused on is driving efficiency.
So by depleting the capacity of the accounts receivable of the U.S. government, you deplete the capacity to collect revenue.
You got income up, but spending down. That is a trend that continues. That could be a concern for the Fed.
Are we going to see an economy in Q1 that is exceptionally robust? No.
Recession risks are rising, but I think once the Fed gets on the right side of the 8 ball, recession risks will decline.
Hello and welcome to Ask You for a Trend. I'm Josh Lipton, and for the next half hour, we're going to be breaking down the trends of today that'll move stocks tomorrow. There is a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here's some of the trends we're going to be diving into. It was a roller coaster day for markets, ending with the major indices surging to finish the week, all closing near session highs. Despite the positive finish, though, to February, markets still closed the month in the red. We'll dive into the rest of today's market trends straight ahead. Then SoundHound AI just reported its strongest quarter on record. I'm going to sit down with the company's CEO to find out what is next. Plus, a downturn in consumer spending means a spike in foot traffic for discount grocers like Aldi. We're going to explore the current grocery and retail landscapes. Well, Bitcoin is slumping and moves in China. We're looking at the trading day takeaways with Yahoo Finance's Jared Blickery. Jared.
Well, we did have kind of a February fallout here, and let's just survey the damage. We had a bit of a rise into the close on the last day of the month, but S&P 500, worst month since December. That's not too bad, December of last year. Nasdaq Composite, though, you'd have to go all the way back to September of 2023, and then you get to something like the Dow, the Russell, the S&P 500, and the equal weight. That's also December of 2024. Not so bad, but then you get to Bitcoin. We're going to cover that in a bit. You have to go all the way back to 2022. So I actually sat down with Michaela Galina over at Wave HQ on the latest episode of Stocks in Translation, going to hit next Tuesday, and we were talking about risk management ahead of this and in spite of in the midst of everything that's happened. Here's what she had to say about the psychological factors.
We all face these same issues. The three that I really pay attention to are loss aversion, recency bias, and confirmation bias. I think loss aversion is fascinating because it's essentially the concept that we feel losses as an investor at 2x the rate of the emotion that we feel joy when it comes to gains. And there's fascinating neuroscience about this. The neuroscience actually tells you that when you feel a loss as an investor, the same part of your brain that lights up when you feel physical pain lights up.
So if it feels like a gut punch after this month, that's understandable. So that's where we land, but we head into March.
So exactly, so February, rearview mirror. I was gonna ask you March, things pick up? What do we know?
Well, I was just presenting this map of the entire year, 2025 seasonality. If you look at this green line here, I'm not going to spend too much time on it. We almost have perfectly traced out what has happened, what we thought was going to happen. We are right down to the zero line. We are flat for the year. Unfortunately, March tends to be a little bit negative with this map too. I blew this up, and it's the white line right here. So we go up a little, then down a little, then we close just under the water line for the month, for the mark. And then I also have another seasonality map. This one is going to be more common. This is the average since 1990 instead of 1928. This has us going a little bit higher after an initial downturn. We'll have to see what happens, but the white line is the one that's been working this year, so that's kind of my base case.
All right.
We got to move on here, and guess what? But China, because China was a huge story this month. It was a green story. And to be fair, we had some other green in the markets. We had bonds, I believe gold too. That's another market we could look at. But we want to look at China here. And this was led by Alibaba with gains of 34%, even after a 10% decline the other day. Still really leading as far as the other mega caps of China go. And it wasn't just Alibaba, it was some of the other Li Auto here up 31%, Xpeng 41%. So those are the auto trades. But let me show you the 1 year. Alibaba up 79%, so that's not bad. Some of these other names have had some troubles, but it all gets back to what happened last September with the stimulus announcements. Are there going to be more? A lot of the price action here is just kind of predicated on the China growth story re-emerging. But we're going to need some more catalysts probably from the government.
Yeah, I had investors, I had strategists on the show. I remember actually telling me China was uninvestable, Jared.
Yeah,
uninvestable.
Well, a lot of people have said that, and I've said that myself because can you trust the PBOC? Can you trust the government over there to not undercut the capital markets as they have done many times before? So we'll have to see. Final point here. Hammer time. And what does that mean? That's Bitcoin. And I do love a good hammer candle. I'm going to show everybody what that is in just a second here. Let me punch up Bitcoin because we had the Bitcoin in free fall yesterday, and it might be a little hard to see. This is the candle that we're looking at today. There is a tail. It's also called a wick that extends all the way down. Let me show you. We have this magical 200-day moving average. Just touch that. It undercut that 200-day moving average, but it's no surprise that's where it stopped. Now, I was on the show yesterday, I was looking at volume support. So we have volume support a little bit lower than that. I've said this thing is probably going to 70,000. I still tend to believe that. I think this is a pit stop. But for the time being, it is pausing here and it's at 84,000. I think investors can at least sleep at night, go home over the weekend and well, it's going to be moving, so maybe you can't sleep at night.
I was going to ask you as we head into the weekend whether you're buying Bitcoin. That's what the people want to know.
Yeah, maybe.
Maybe. I'll take a maybe. Thank you, buddy.
You bet.
Appreciate it. SoundHound AI reported its strongest quarter on record with $34.5 million in revenue. That did mark an increase of over 100% year over year. And joining us now to break it all down the quarter and discuss what is next for the company is Keyvan Mohajer, SoundHound AI co-founder and CEO. Keyvan, it's always great to see you and to have you on the show. So listen, you reported, Keyvan, clearly investors like what you had to say. Your stock surged about nearly 20% in today's trade. Walk us through the quarter, though, Keyvan, and what you're seeing in the business.
Thank you for having me back. Great to be here. We had a record quarter. It was a beat and raise quarter. Almost $35 million of revenue, up 100%, more than 100% year over year. Also a strong cash position, almost $200 million of cash and no debt, so we feel really good about that. We heavily diversified our business. We provide AI for cars, we provide AI for restaurants, and now we are in retail, healthcare, financial institutions and insurance, government and military. And then we had a really big deal in a new sector, energy. We had a large deal with one of the biggest U.S. electric utility companies in Q4.
I'm interested, Keyvan, investors very interested in AI, excited about AI. You've been thinking about this technology for a long time. I have a technology question for you, Keyvan, which is as these AI models, as they get smaller, as they get more efficient, Keyvan, what does that mean for your company? I mean, how is that going to improve your products?
Great question. We actually made the prediction that models will get more accurate and less expensive and faster. Years ago, we said, just don't worry about costs. Just go and build these amazing user experiences and make them really good. Make them good enough to be able to go live. And as they get better, a lot of it comes from us. The products will get better, and that's happening. Compared to 2 years ago, we have a lot more models out there. Some are made by SoundHound, some are open source, some are third party. And our architecture taps into those models depending on the use cases. Sometimes there are smaller models that can run on the edge, run in the cloud. Sometimes there are more expensive models that are in the cloud, depending on what the user is ultimately asking.
Did you, Keyvan, when you heard DeepSeek's claims, some have been skeptical. What did you think? Did you believe all their claims?
Well, they actually made their model open source and put it on the internet so you could download it and test it. It actually was a good thing for companies like SoundHound because, again, we rely on innovation that happens within SoundHound and outside of SoundHound to make our products better. And that was a positive update for SoundHound.
On the business side, Keyvan, you've made acquisitions that have allowed you to move into new verticals. I'm curious, are there certain verticals, Keyvan, that are already seeing more traction than others? And how do you rank those verticals in terms of what you're going to emphasize as a business and as a CEO?
We spent 10 years building the technology, and in 2015 we unveiled it. The traction was great. We started in automotive because we didn't need to convince car makers to adopt voice AI, and then we went to customer service. We started with restaurants. We said restaurants to us are what books were to Amazon. Let's start with restaurants and then expand to other verticals. And then through organic growth and acquisition, we have been able to accelerate that expansion. And ultimately, we believe every business needs customer service, AI customer service, whether you're a large insurance company to a single location barbershop. And we are building solutions for all of those. So a single location barbershop or a plumber or restaurant, within minutes, they can have a very affordable AI customer service. And a large financial institution or insurance company or healthcare company can have very sophisticated AI that we collaborate with them. So we have a big range of customer base.
Yeah, I noticed, Keyvan, too, on that conference call, the military was mentioned a few times. I'm wondering if you could give viewers a little bit more color about the work you're doing there.
So ultimately, we provide voice-enabled conversational AI for businesses. I can't go into more details, but the great thing about our business is that it's very repeatable. So once you make it, you can sell it again and again it's the same type of experiences that we can sell to different industries.
And finally, Keyvan, you were in the news for a different reason, which was Nvidia. Gave us some color on recent investment decisions they made in the fourth quarter, including, it looked like, Keyvan, exiting their position in your company. Any kind of insight you can provide on that decision?
Yeah, we have a great relationship with NVIDIA. We were in CES together. We had a joint demo in our booth that was very well received. We are also going to participate at the NVIDIA GTC conference in March. So the relationship is very strong. We have attracted investment from a lot of strategic investors, multiple automakers and cloud providers and device makers and chip makers. I can't speak to their investment philosophy, but in my opinion, they don't want to hold public company shares. They make these investments to create ecosystems and alliances. And those have been benefited SoundHound. In case of NVIDIA, we were able to use the investment to port our technology to their hardware and software stack, and that ultimately increased our addressable market.
Keyvan, thanks as always for taking the time to speak with us. We appreciate it.
Thank you so much for having me.
Stick around, much more Asking for a Trend right on the other side. Well, the Federal Reserve's preferred inflation gauge cooled as expected in January. However, the good news came with another potential red flag for the U.S. economic engine. Consumers pulling back their spending by the most in nearly 4 years, with shoppers becoming more spend conscious. Discount grocers like Aldi are seeing a spike in foot traffic. Joining us now is Naveen Jaggi, JLL President, Retail Advisory Services. Naveen, always good to see you. So I want to dig right into this report, Naveen. You have a new one out. You really dug into the grocery vertical, and that's where I want to start. When you all look into grocery retail vacancy, I'm curious, Naveen, what are the trends you're seeing there right now?
Well, I mean, first of all, the grocery sector is probably still the hottest sector in American retail today. And from the investor community, they're still looking for more and more of those grocery anchored shopping centers, whether they're anchored with a Whole Foods or an H-E-B or a Publix or a Kroger, et cetera. So we still see that as the most desirable asset class from an investor standpoint. The vacancy question that you've asked is that there's not much vacancy in a grocery-anchored shopping center in the prime and major markets across the USA. And we're not hearing anything to tell us that that's going to change. If there's going to be any pivot at all, Josh, is that we're going to likely see the consumer start thinking more discount, more value, and more bang for the travel and the trip. So if you think about it that way, they'll likely try to get to a grocery store and get as much of their purchases at one time as opposed to making 2 or 3 stops. So the vacancy issue doesn't concern me at all right now. What really concerns me is that the consumer confidence index is dropping, and that tells me they're concerned about the unease and the broader economy foundations.
Can I ask you something, Naveen, about that, though? If there isn't much vacancy and you have, still elevated construction costs, if I'm a grocer and I'm hoping to expand my footprint, what does that mean looking ahead?
Well, look, you have to adjust your pro forma to the new cost of doing business. I mean, there was a reality that started sinking in between 22 and 23 that the days of cheaper capital, the cheaper cost of all the things that you do to build a store aren't going to come back down to 2019 days ever again, or not in the near future anymore. So where you had a pause in 2022 and 23, the reality is today, if you want to do a deal, you want to do a grocery store deal, you'll have to pay the current rate. And the current rate means that the cost of construction, the cost of labor, the cost of FF&E, all of that is higher today than it was 3 or 4 years ago, and you can't expect it to come down, which means your rental cost goes up, your occupancy cost goes up, which means over time that we'll have certain levels of inflation on certain products on the shelf.
What is the investment appetite right now like in this space, Naveen?
It's still hot. I mean, of all the major asset classes in retail, the grocery anchored shopping center is the hottest class in America. Now, keep in mind, roughly 70% of all the investment sales in capital markets for retail in 24 came from the private client side, which goes to tell you that where institutions have been careful about how they invest their funds, the private capital, the family office, et cetera, are filling that gap. And so we're seeing a large pivot towards more and more investment dollars coming from the private side, which they're playing much more aggressive because they have a long mentality as opposed to a short-term mentality.
And Naveen, when you look at the overall grocery market, where is the foot traffic?
The foot traffic is high, certainly high in the major markets. We're starting to see it in the Sunbelt markets. We're starting to see a little bit of softening in January, of course, in February, just because I think the inflationary environment that we're in is softening some of that foot traffic. And I wouldn't be surprised if we see some of that continuing as we start feeling that the consumer reacts to what's happening in Washington. And what we all know at the end of the day, Josh, is that the consumer reacts when the market is calm and when it's certainly able to estimate how it's going to behave. And right now, there's certainly a sense that the market is not calm, the world is not calm, and when you have that combined, consumers start being more cautious with their dollars.
We always talk about the consumer, Naveen, as if it's one consumer, but of course, there's different kinds of consumer. Do you expect this sort of trend of a bifurcated consumer to continue, meaning the high end doing okay, but more pressure for mid to low income?
Yeah, I think we've seen that for the better part of 10 or 15 years now, Josh. Look, we have a barbell economy today. We have the value consumer and we have the aspirational consumer. But the reality is when it comes to food, when it comes to groceries, it's not too often that you'll see someone go to a high-end grocery store. The reality is that the vast majority of Americans, nearly 80% of all Americans, shop at a similar grocery store. Whether you're in suburbia USA or urban markets, you're going to be shopping at a Wegmans, to a Kroger, to an Albertsons, to an H-E-B if you're in Texas, or to an Aldi or a grocery outlet or a Dollar General if you're on the value side. So the reality is, no matter what demographic you're in, you still need groceries every day, and you're sensitive to, and at least will notice when egg prices are up, when milk prices are up, and bread prices are up.
Naveen, always great to see you and have you on the show. Thank you for joining us.
You bet, Josh.
Coming up, we're taking a look at the Atlanta Fed's first quarter GDP forecast and our chart of the day. More asking for a trend that's right on the other side. A possible warning on the health of the economy coming from the Atlanta Fed today. Yahoo Finance's Julie Hyman joins me now with a closer look at our chart of the day. Julie.
Yeah, and this is something we've been talking about, or alluding to at least, all throughout the show today. What the Atlanta Federal Reserve has is something called its nowcast, its GDP nowcast. So effectively, this is a real-time GDP forecast that is updated frequently as we get all of the daily economic reports. And so what we saw after the PCE numbers this morning and the personal spending numbers this morning is a new reading come in showing a potential decline of 1.5% in GDP growth for the first quarter. Now, why is this of such concern? Most of the mainstream economists have been thinking it would be around 2%. There are two reasons that we need to put this in context. One is, as I said, this is something that is updated frequently. It's a nowcast, right? It's not a sort of a traditional forecast. We're going to get more economic data between now and the end of the quarter, including, of course, things like the jobs report. And so we are going to see this number updated. That's thing number one. Thing number two is that some of the data that we got this morning was about imports into the United States. That's something that seemed to provide a drag here. Those imports coming in part, according to economists, this is what they're theorizing, is that there's a surge in imports because of the anticipated tariffs going on some goods. So there also should be a normalization process as those goods then make their way through the economy. There might also be a normalization process in the coming months, depending on what happens with tariffs. All of that means this negative 1.5% is not likely to stay there. However, it was another reminder that there are these growth concerns that have been sort of plaguing the markets. Some economists we've spoken to, including from the Investment Company Institute today, say these are legitimate concerns. We should keep an eye on them. We also talked to Nancy Tengler about the ongoing debate in the market about whether there is an actual growth scare and or if there is a momentum unwind in some of the large cap tech stocks. She leans towards the latter. Wherever you slice it, this is a number you're going to be want to watch closely in the coming weeks as we get more and more data, because guess what? Market participants, institutions are watching this number as well, Josh.
All right, thank you, Julie. And that is a wrap on today's Ask for a Trend. Be sure to come back Monday at 4:30 p.m. Eastern for all of the latest market moving stories affecting your wallet. Have a great night.